as I pointed out, the Bank of India management lined up to get you a sense of how the outlook is going forward. Remember, the numbers were quite good. The bottom line has grown quite substantially. Though there is a question mark about the compression that they saw in the net interest margin, they've actually seen a very stark improvement in the asset quality as well. Let's listen in to what the management has to say.
I want to first start off with that margin number. It's compressed. Are we at the bottom? And if there were to be more rate cuts, how low could it go?
Yeah, good morning. Thanks for having me here. Yes, NIMs have come down. We are at a global NIM of 2.82%. It has come down. But if you see our overall NIM, so we have a 12% book which is an international book also. So banks which have international book have NIM which is slightly less. But if you see our domestic NIM as on 31st March 2025, we are at a healthy 3.10%. So as regards the NIM guidance which is concerned, definitely there is some pressure on the NIM because of the falling repo rate scenario. So already we have seen the two cuts, one in February and another one in the month of April. And there are further cuts anticipated as per market commentary. So if the rate cut further goes down, the repo rate further goes down by say 50 basis points, definitely the margin, the NIM pressure would be at around 15 basis points. Nonetheless, we will be trying to maintain our NIMs, in fact improve our NIMs. A few strategies are there. One is improving the yield on advances by focusing more on MCLR linked advances. The second thing is with respect to controlling the cost of deposits by improving our CASA and retail term deposits, and also increasing the non-interest income. So that would be the overall strategy. This time we have done quite well as far as the non-interest income is concerned. This financial year FY26 will again try to do much better in the non-interest income, particularly with regard to the recovery in the return of accounts. So that will help us in protecting the overall NIM of the bank.
Point taken. So sir, if I were to sum the margin possibilities up, a 50 basis point rate cut exposes you to around a 15 basis point reduction in NIM. Is that correct?
Yeah, that's correct, because the transmission on the deposit side takes time.
I understand.
So every rate cut, the majority of the transmission would take place by September 25, and the April rate cut, the transmission would happen by say October 25. So the transmission in deposit side takes time. That is why which creates the pressure on the NIM. Nonetheless, we have other strategies in place to protect our NIMs in going forward for FY26.
Correct. So lead and lag. So fully point taken. So when they recover, where should the margin number normalize at, sir?
So this financial year we should be ending at a global NIM of at around 2.70%.
Okay, point taken. Now let me talk about other income, because that very strong growth in Q4. You believe there are one-offs? What explains it?
See, other income, if you see Q4 and then if you see the YOY basis, March 24 to 25, our non-interest income has increased by nearly 46% on a YOY basis. This has improvement is there because of the recovery in the return of accounts throughout the year, which is much better than which was last year. 61% is the YOY growth on that. As regards from the treasury income side, interest on the treasury income, there the income has tripled over the YOY basis. So these are the two key fundamental reasons for which the improvement in the non-interest income is there. We are focusing on the non-interest income very strategically so that the overall income improves, and the pressure on the NIMs which is coming through the net interest margins and the net interest income gets reduced.
So, on the credit cost front, slippages in agri and MSME have both doubled on a QOQ basis. Is this just seasonality, or is it a cause of concern, and what's the outlook like for FY26?
So major portion of our slippage is coming from the MSME and agriculture, if you see. In the agriculture side, I can substantiate that there were certain changes in some of the state SLBC formula, wherein as per the IRAC guidelines of RBI, there were certain slippages in the agriculture side. But if you see on the YOY basis side, our credit cost has in fact come down on a YOY basis. It is now at 1.38% as against 1.56% last year. So we have reduced our credit cost by nearly 20 basis points. if you see the overall number, the number is flat at around 7,500 crores of fresh slippage, which has happened. The slippage ratio, in fact, is 1.38, which I was telling. So the slippage is at around 7,500 crore, which is the same as per the last year. But this year we had one large ticket corporate slippage of around 1,000 crore of a PSU. Had that not been there, the slippage ratio would have been much better. So, but nonetheless, in this financial year FY26, we are very much confident that the slippage in this year will be much lower than the number which was this year, and we'll be able to protect not only the slippage ratio would improve, but also even the credit cost.
But why is that so, sir? What gives you the confidence for FY26 versus what went wrong in FY25? Just give us that understanding.
So as I explained earlier, 1,000 crore was one single PSU which was there, right?
Okay.
So had that not been there, our slippage would have been only 6,500 crores as against 7,500 crores. That is one point. Second point is that if you see our SMA numbers 5 crores and above, the SMA number which was last year 7,100 crore in March 24, it has come down to 4,900 crores in March 25. There also to the total standard book of the bank, this above 5 crore SMA is only 0.92%. So the credit call, otherwise the book asset quality is okay, fine with us, and the lumpiness in the SMA book is also because of few accounts which are of this one state PSU. There also in all those 4 accounts we have state government guarantees, and we do not see any delinquency coming in that. So this year we are very confident that the slippage whatever happened in this year FY25, it will be much lower than this number.
Point taken. So give us the growth guidance and the credit cost guidance for FY26.
So as far as the growth guidance is concerned, deposits, we are giving a guidance of around 11 to 12%. And for the credit side, we are giving a guidance of around 13 to 14%. And on the credit side, credit cost side, you have seen that the credit cost of the bank has come down in this financial year, definitely, and overall provision also has come down, in fact, on a YOY basis by nearly 1,000 crores. For FY26, again the credit cost, we should be down by another 10 to 15 basis points in FY26.
Point taken. So my last question again is going back to non-interest income. A large chunk of the non-interest income seems sustainable. But you've got around 700 odd crore of treasury income as well within that. So give us color. What is the recovery pipeline looking like for FY26? So what will that number look like? And second, with regard to other income, is that where is the normalized steady state number looking like? Are all the other line items outside of treasury sustainable? Even treasury, is it sustainable or not?
See, last year we had done a total gross cash recovery of 7,800 crores. This year our gross cash recovery is around 9,500 crores. FY26 we are internal management target, we have kept ourselves for a gross cash recovery of 11,000 crores in FY26. So that is the kind of number we have kept ourselves. So it will be incremental delta would be at around 1,500 crores in the gross cash recovery. As regards to the non-interest income is concerned, there also we are expecting a better number. There has been, as a strategy, we have built up our treasury book over the last 5-6 months when the interest rates were higher. Now in the falling interest rate scenario, when the repo rate is coming down, so we are anticipating that we will book some profits out of that book in the treasury book and earn some income, some non-interest income out of that head. Another important point in the improvement in the non-interest income is also the penal interest which was taken earlier as per the RBI circular are now coming in the penal charges. So there also there has been a bolster in the non-interest income because of the shifting from the penal interest to the penal charges. So that number is overall sustainable. As I said, that we will be doing good in the recovery numbers in this financial year also, and some gains will be there in the treasury also. Overall, keeping in mind both the things, our non-interest income will be remaining buoyant in FY26.
So FY26 full year ROA, what's the kind of number that one can expect with all of these levers that you have? Is it 1.1%, 1.2%? What's the bullish case?
Yeah, so if you see our ROA, as a growth trajectory, we have improved our ROA on a YOY basis. Our ROA was 0.70% only in March 24, which is now on an annualized basis at 0.90%. If you see the quarterly glide path which is there in the ROA, we have touched the ROA of 0.98% in March 25. So that is the kind of number. In this financial year, for the glide path, I would say that we would like to touch the ROA at 1% by FY26, and to touch that number, as I said already, we will be growing our top line numbers, our bottom line numbers, our operating profit and net profit, and also obviously our non-interest income and the key fundamental ratios which are there with respect to gross and net NPA, our credit cost and slippage ratio. All these things put together will help us to give a ROA of around 1% in FY26.
Okay, so some key numbers that you should watch out for with regard to Bank of India. One is that ROA number that was just spoken about, and also the global NIM, which is seen at 2.7%, the net interest margin. The quarter gone by, there was erosion, and you heard from the management why that took place and how it's expected to stabilize at 2.7%. The stock is doing particularly well. In fact, the Nifty Bank is down about 0.4%, so this